What's going on? It's Ryan here, CEO and head quant here at Happy Trader. Today, we're going to go over why selling options is better than buying options from a probability statistical standpoint. We're also going to explain a little bit about how to protect that position because when you sell options, and this is really, really important, make sure you watch this video. If you're selling options, if you've ever sold an option, or if you're thinking about selling options to make daily or weekly income, this is going to be a video that you're going to want to watch. So we're going to try to do this thing all in one take, and this is just going to be a quick overview of exactly why. We're going to look into a bunch of different charts and a bunch of different risk reward ratios and stuff like that. Now, as you can see with Happy Trader on today being January 2nd, you can see the market appears to be going sideways to up when you're looking just at the price action, but you can see that with happytrader.io enabled, our proprietary software, you can see we're looking at a macro downtrend. This is a great time to talk about put risk. If you're putting puts on, expecting that the market's going to go up. So we're going to go into the options chain here. This is just on a E-Trade paper trading account, and we're going to look at today's expiration because why not look at 0 DTE? And like I said, we are in a bull market, even though today is down, being the first trading day of the new year. This is what people are normally going to do. So let's say you want the market to go down, right? So you're like, oh, well, I'll buy an out of the money put. Well, you can look at the snapshot analysis here and you can see, okay, great, max profit, it looks wonderful, max loss, okay, great, just the premium you pay, right? So, but look at the probability for that, right? So what happens if you flip that around? And we're just going to go into edit ticket and we're actually going to sell that same out of the money put and then just check the snapshot analysis, okay? Oh, wow, that's interesting. Our max profit just went up to a 94% potential instead of, max loss being a 94% potential, right? So there's a couple things that you can do, and I'm not telling you how to trade, but there's a couple things you can do. So even if we go into the next strike there, and we just do a put vertical, meaning we're selling at the 18 delta, meaning we're controlling 18% of, let's call it $47,000 worth of SPY, okay, or SPX, right? So, the S&P 500 index. So the tightest possible spread on SPY is going to be, with a little bit of meat on the bone, is going to look something like this. Okay, so you can see the snapshot analysis right here. You zoom in a little bit, you have the price of the security in the middle. You have this thinner green line, which is where, this is where the strike is that we're selling. If you want to sell further out, you'll collect a less premium, but you'll have an even higher probability for maximum profit. Max loss probability, only 1%. Now, can you get those odds in the lottery? Nope. Can you get those odds, flipping a coin? Nope. So, this represents a high statistical edge as far as selling puts, right? Now, the problem you might run into, though, is what if it is that 1% of the time and you take this highly asymmetric loss, which in this case is only $445. But when most people are selling options, they're going to try to get as much premium as possible, or at least a lot of premium, right? So, let's just say, we wanted to go for a ton of premium. This would be like a typical, like a 25 delta, like really close to the money. 47.35 would be the strike that we sell at, and that's not far from the money. It's 1 o'clock, 1:13 p.m. on January 2nd. So let's go back to the snapshot analysis here, and you can see if we zoom in, we get a little bit more room, but by collecting more premium, you can see we still have a really high probability for max profit at 175 and a 0.02% chance of losing. I mean, would you take those odds on a lottery ticket? I don't know. I might. So, here's the caveat is that when, the market does start to go down, not only are you going to be losing money before expiry with a theoretical P&L, if it breaches that strike and there's a huge sell-off at the end of the day, or let's say that funds or institutions are rebalancing, whatever the reason might be, and you're sitting there with this sold put, even with a spread on the market. Now, that market, we either get a news headline or, the president comes out and says something or whatever it is. It could be the Fed, and then the market goes down and breaches your strike. Well, what are you going to do in that scenario? And it happens a lot more than you might think at far out deltas, right? So, very far out of the money. Now, generally speaking, me personally, if I'm selling premium, I like to be around 5 to 8 delta. But if you're later in the day and you're actually trying to make income from doing these trades and you're actually trying to pay bills by doing these trades, sometimes you have to get closer to the money. So, one thing you can do is, you can see you're putting on this trade for a credit. What you can do after you put the trade on is you can just essentially, you know, do a 1x or slightly lower than a 1x. You could do a 1.5x stop using stop limit debit. So, you could put even just like a $3 stop loss. And what that'll mean is when the market when that option chain, like let's say there's a huge move down in the market, when that option price, essentially doubles in loss from the credit received, or doubles and a half, or some people do 2x or 3x stops, that's where you're going to hit your trigger. Then it's going to put on your stop limit price. So some people like to do, 295, give it a little bit of room, or at least trigger it maybe a 275. But then you have to worry about slippage. So the closer your trigger is to your actual limit price, that's going to represent potential slippage. It doesn't mean it's going to slip. It just means it could. Now, when you're trading on something very high liquidity, like the SPX, the SPY, whatever, you have less of a chance. But still, when you're selling an option, you have to be aware of a few things, especially 0DT. The first thing is that you can get assigned on the short leg. Now, that's why you would trade SPX instead of SPY. Now, the caveat with that is the SPX is going to be 10 times the size of the SPY, right? So if you go to the SPY, you can see that, if we go to put vertical, you can see that we're collecting pennies on the dollar, and that's at the money. That's not even selling out, right? So you can see the snapshot analysis here, and bang, look, we're not even in the winning zone, right? And that's the most we can collect. But it's a more, symmetrical risk reward profile, like I've mentioned in some other videos, doing like 50-50 trades and stuff like that. So really, with the SPX, it's a better overall and better quote unquote, because you're not going to be assigned on that short leg, but you do have to worry, because when you're, collecting premium or selling a put vertical spread, and let's just put another one on, it is 10 times the size of the SPY. So if we wanted to collect, let's say, $155 in premium, it's 1:17 p.m. The market closes at 4. Well, be prepared to possibly lose, maybe not 1,300. That's a little deceiving. But if you breach your strike, you could get a $900 loss. Look how fast that cliff falls off, and you can see the theoretical P&L at expiry as well. And you can see that, you will hit that max loss pretty quick after that strike is breached, because you're looking at this cliff here, right here, this corner, compared to this corner here to start your theoretical P&L at max expiry for max loss. So yes, selling options is going to be better, because you are banking essentially on theta decay, meaning anything that's outside of this little cloud is out of the money. And if it stays out of the money, it's going to, go to zero, right? And then you have to look at the next day. That's why if we're looking at the money, if we cancel this out, if we're just looking at, this is in the money, this is in the money over here, all this stuff with the black background is out of the money. So all we have to do is, you can see the premium amounts here. Let's go to tomorrow, and you can see that the premium amounts, let's go to the at the money strike, are way jacked up, right? So they have, decayed over the course of the day. And that's what those strategies do, where you're selling premium, is you're waiting on that premium decay. But you have to make sure, with those juicy premiums, there's no free lunch on Wall Street. With those juicy premiums is going to come potential for a really high loss. So again, you can lose. Make sure your risk management is in place. Make sure you have stop losses on, and don't be afraid to use that stop, limit debit is going to be your real savior. If you're collecting any sort of credit on a trade, you need to make sure that when you're looking at that snapshot analysis, that if that max loss is 10x, if it's 8x, if it's 7x, that's going to take you that many more trades to put on, and that's going to give you less, expectancy. Right now, the next thing is, and I guess the final thing is like, how do we identify when to put those trades on? Well, you wouldn't look at the 45-minute chart with something like Happy Trader. What you would do is probably look at the 5-minute chart. Now, for Happy Trader, the uptrend and the downtrend signals are going to be your actual trading signals, right? So you can see, like, for instance, today, you can see we had 2024 as the new year. We had an immediate sell signal, and then we had a quick downtrend signal. And then, the market did kind of dip around, retrace, dip around, retrace. But there's really no clear sign of a signal. So how do we decide whether to put on a put or a call vertical spread? Well, it does depend on these uptrend and downtrend signals in back testing, and that's something that we have on a lot of other videos, is back testing about how accurate these signals are under different back testing conditions. So, for instance, you could get a downtrend signal and sell a call. So let's just theorize that we had this downtrend signal off today's open at, like, right at 9:30 when the market opened, just dumps, after kind of getting bid up a little bit into the open. Well, what we were just looking at is selling out of the money. Okay. So we're looking at selling kind of up here. So if the price is here, maybe we're selling kind of up here or up here. And then if we get either our signal invalidated, or if we hit our stop loss, which could be a 1x, a 1.5x, a 2x, whatever, like I showed you in the options chain, those would be the criteria not only for getting into the trade, but exiting the trade potentially as well. So generally, the way I like to do things is, if I put a trade on and that trade invalidates my initial thesis, it doesn't matter what the loss is. It doesn't matter about how I'm feeling. It doesn't matter about ego. It doesn't matter. The market does not care what you think. The market is like the ocean. There's currents, and you either go with them or you go against them, and you're going to get swept up by them, right? So just don't forget that concept. So you have to make sure, you have something that gives you an edge. So Happy Trader, which is really great for that. Shameless self plug. Make sure you like and subscribe. There's another self plug. We are a startup, and we do make some of the best uptrend and downtrend signals available. Just wanted to throw that one out there, because without our signals and without our alerts, you're pretty much just a sitting duck. You can see the market went down, but really, it looks like the market's about to get bidded back up, right? But we wouldn't know that without having Happy Trader on, getting another buy signal, and then getting an uptrend that's like not super flat, like this Illuma trend right here, this weakened downtrend. Okay. So, again, that's today's video. That's why selling options is statistically better than buying options, but all strategies have their place in trading. I hope this helps somebody out there, whether you're a beginner, intermediate, or expert trader. Again, my name is Ryan, CEO, head quant here at happytrader.io. Like, subscribe. Good day. Happy trading.